MichaelJMauboussin, More Than You Know, Finding Financial Wisdom in Unconventional Places. Embark on a captivating exploration of financial wisdom with MichaelJMaubousin's More Than You Know, Finding Financial Wisdom in Unconventional Places. This book summary delves into the intricacies of investing, striking the balance between outcomes and processes, and recognizing the characteristics behind investment success. Alongside these essential topics, the summary sheds light on the psychological and emotional forces governing the decision-making process indulged in by investors. Furthermore, it highlights the significance of understanding the impact of innovation and change on the market while emphasizing the need for diversification and adaptability amidst the rapidly shifting financial landscape.
The importance of investment philosophy. Investment decisions should be based on philosophy instead of IQ, with patience and diligence being more critical than achieving great outcomes. Focusing on process versus outcome is key, as a good process may sometimes lead to bad outcomes, but will ultimately outperform a bad process. However, the investment community often prioritizes outcomes, leading to an excessive focus on this metric. Unveiling the secrets of superinvestors. Learn about the characteristics of exceptional money managers and how they differ from average money managers. Despite the difficulty of consistently beating the market, some exceptional money managers achieve this challenging task. These superinvestors have several distinguishing factors that set them apart from average managers. Firstly, they have lower portfolio turnover and hold high concentration in their top stocks compared to the market index. Additionally, they are value investors who seek bargains and are often not based in influential financial hubs such as New York or Boston. While experts continue to study the market, many aspects of its behavior remain a mystery. This knowledge gap fuels debate about whether investing is a profession or a business. Although short-term business considerations often dominate, the most successful investors tend to embrace a professional approach. These investors think long-term, charge low fees, and invest as contrarians. By holding on to investments, they avoid frequent transaction costs and are immune to the drastic fluctuations of volatile markets. However, professional investors also risk losing their jobs by making decisions that may threaten the short-term goals of their firm. Ultimately, the best money managers prioritize professionalism and strategic investing over short-term business goals. Unfortunately, this may leave them vulnerable to being fired by firms that prioritize business objectives over exceptional performance. The art of being right. Great investors focus on the circumstances of a company, and their success shares some characteristics, such as expertise, examining multiple situations, and betting carefully. Babe Ruth's story proves that how often one is right doesn't matter, being right for bigger stakes does. Myopic loss aversion keeps people happy even if they are right for small amounts. In probability-based exercises like gambling or investing, one has to kiss a lot of frogs to find rare opportunities, and few opportunities are usually in their favor. Investing is better because one can wait until the odds favor them, and they don't have to bet. Standard financial theory focuses on the company's attributes, but it's important to analyze their circumstances. A highly skilled player will have more streaks in basketball, and the same goes for successful investors. Our desire to connect cause and effect often leads us to make up stories about investing. Understanding the markets through behavioral finance. Understanding the markets involves more than just knowing your own beliefs. Behavioral finance has revealed that investing is not strictly rational, and emotional factors are necessary for making sound decisions. However, emotions can also lead investors astray. Great money managers are aware of their emotions, but they understand the reasons for their decisions. The markets are collectives, and understanding them requires knowledge of what other people believe and what they are going to do. Many stress factors affect today's markets, leading managers to make short-term decisions and exhibit unhealthy responses to stress. Investors are subject to psychological and emotional forces such as reciprocity, consistency, social pressure, affection, authority, and the tendency to ignore contrary information. Imitation can lead to better decisions based on collective wisdom but can also trap investors in dangerous herd behavior. Favorable situations do not appear often, so investors must be competent and have a clear-cut variant perception vis-a-vis the market. Behavioral finance has revealed new facts about economic decision-making, but it has not provided a consistent or comprehensive way of thinking about the markets. Innovation and investing. The book discusses the impact of innovation on investment and the need to understand patterns of change. With the digital age, intellectual resources have become the primary source of wealth. Industries progress through cycles of proliferation and pruning. Investing in an industry after pruning can lead to higher returns. Innovative companies provide higher returns but only for the first 5 years. The market undervalues innovation at the earliest stages, then overvalues it. Long streaks indicate skill in various domains. As change is rapid, it's important to set simple rules that allow decision-makers to react to circumstances within those rules. Companies and investors may need to accept a period of underperformance to lay the foundation for market beating. Lessons for investors. Social Security's problems emerged from changes in demographics that relied on historical data, which is not a good guide. Similarly, investors make the same mistake when using historical data to guide the value of securities. Taxes, inflation, and the cost of transactions have changed, making it difficult to compare intangible and tangible assets. The equity risk premium is also changeable, and investors should take the price/earnings ratio with a grain of salt and be prepared for wider portfolios and higher turnover. Companies that outperform the market are temporary members of a permanent class, and companies should develop long-term decision rules that allow managers to make the right short-term decisions. The historical average price/earnings ratio provides little or no guidance about market returns, and most companies do not recover after a downturn. Collective intelligence, lessons from social insects. Recent research shows that social insects like ants and bees can collectively solve complex problems without any central direction. They optimize their behavior based on diversity and temporary specialization. Humans can learn from their example, as the collective behavior of individuals who work independently may be more powerful than the advice of experts. The stock market, in particular, can be seen as a sort of ultimate ant colony where independent investors drawing on various information sources generally arrive at a sound assessment of values. Hysteria and madness occur when investors stop behaving as diverse agents and begin acting in concert.
To sum up, More Than You Know encapsulates essential insights into investment success and underlines the importance of a well-structured investment process. Notable ideas include the value of long-term thinking, diverse information sources, and embracing innovation as it unfolds. The summary also underscores the role of emotions and instincts in decision-making, challenging conventional perceptions on the rationality of the investing process. It expands on the transformative role of intellectual capital in the modern economy, signifying the need for adaptability and flexibility while weighing risks and rewards. Ultimately, the book provides remarkable guidance for investors eager to grow and evolve in the world of finance.